I want to share something very important today. I'm a part of a lot of different investing groups across the different social media apps, and it's interesting to see the different posts, thoughts, recommendations, the good, the bad, and so on. And I came across a very sad but unfortunately somewhat common example about losing it big in the stock market. I want to cover this very unfortunate situation by reading you the exact words from this gentleman's post. This is a real situation. And be prepared, it's not pretty. It kind of got me down, but I thought it's important to share something like this. And I'm not doing this to showcase someone who did a bad job investing or to kick them while they're down. It's the very opposite. It's rather to help us all avoid these situations by learning, and I am going to provide you my steps to keep your portfolio safe and profitable and lower your risk, because we work very hard for our money and our goal is long term. That's this channel. I focus on long term investing because short term trading, all that stuff, it's not my thing. But long term, you want to create that good nest egg to live life more comfortably and create some good passive income. So I typed out this post, and I'll put it up here in a minute, to keep this person's identity confidential. So if you are part of this group, please keep it confidential as well. This is something that you'll see. I don't want this person to feel bad in case he so happens to see my video today. So here it is. I'm going to read it all, and then we'll just kind of break it up a little bit. He says, well, the market broke me. I sold the bank stocks I had at a major loss. I never been more ashamed as a man in my entire life. It will take a couple of years to recoup the losses. I'm never investing in an individual stock again, only ETFs from now on. I got burned and never want to feel like I do now. I'm so depressed about this. I feel so stupid for thinking I could outsmart the market. So what I want to do is, obviously this is very unfortunate and something that I kind of do see every so often. It's more common than you think. Let's take this sentence by sentence real quick. It says, well, the market broke me. And I will tell you that a lot of people, I've had friends that have lost a lot of money in the market and it breaks them and they end up quitting. They just don't do it anymore. And that's sad because really you can turn things around. You don't give up, right? You keep going. This gentleman then says, I sold the bank stocks I had at a major loss. So I'm guessing he was allocated heavily into bank stocks, so he wasn't well diversified, and he had all his money in there, and a good amount of it, because it was a major loss is what he classifies it as. Then he says, I've never been more ashamed as a man in my entire life, which also tells me this was a big amount. Maybe it was all his savings, and to have this be the biggest kind of event that has made you most ashamed out of anything in your entire life is big. He says it will take a couple of years to recoup the losses. So to take years to recoup something, that's a big deal. He says, I'm never investing in individual stocks again, only ETFs from now on. So let me just say this. A lot of people, 90% of investors, I think, should only invest in ETFs. They're a much safer, diversified way to do so. You set it and forget it, and you don't have to worry about taking the time to analyze companies for throughout the whole year and the many companies you might hold. And that's risky because any one company, I don't care what it is, even Microsoft, if there's fraud that turns up, that could take a company down big time, and it can happen to any company. And there's a lot more things that could cause a stock to go down. So yes, individual stocks are a lot more risky. And there's ways that I go about that to try to prevent something like that happening, which I'm going to share at the end. But ETFs are a good, solid way to do it. But even with ETFs, you can choose bad ETFs. You look at Cathie Wood's innovation, the ARK ETF, innovation ETF, that thing's been a dud. So you want to make sure there's an ETF with a good track record, that's highly rated. You still got to research and pick a good one. But these funds are actively or passively managed. They're taken care for. Those managers take out, the underperforming stocks, put in good performing stocks. It's constantly being evaluated, analyzed, and updated by someone else. You don't have to do it. So I really think ETFs are the way to go. And I think this sounds like this gentleman's going to get back into the game, but in just ETFs. So that makes me happy. He says, I got burned and never want to feel like I do now. That's just not a good feeling. He says, I'm so depressed about this. So really, this is affecting his life. And I know for us that those of us who invested in something and made a loss, made a bad decision, it definitely is not a good feeling. I can't imagine if it is as big as this gentleman is talking about, where it sounds like it was his entire portfolio. He says, I feel so stupid for thinking I could outsmart the market. Right there, I think, is the biggest takeaway. A lot of investors think that they can outsmart the market. They treat investing like a game, like they're going to beat something. They're going to beat someone else. They're going to beat the S&P 500. And while you can have some benchmarks, I don't think it's about beating. It's about creating long-term wealth. And a lot of people that try to, cut corners and beat the market end up getting beat up by the market themselves, just like this gentleman, unfortunately. So I now want to share how I think we as investors avoid this situation. And it's 4 things I want to say, 4 words that are, I think, powerful and will prevent huge losses and pretty much solidify gains and long-term wealth and lower that risk. And that's diversification, quality, strategy, and patience. So let's look at my portfolio performance. Right now I'm up 4%. So I am not at a big loss. Net, all my stocks together, I'm up over $2,000. This is great performance. My portfolio is relatively young. It's about 2 years old. So it's not a very mature portfolio. So I think this is a very successful portfolio. Of course, I've had some losers like Tattooed Chef. I'm not a perfect investor. I don't claim to be. So I've made mistakes, and I'd love to get out of those that are mistakes like Tattooed Chef, 3M, AT&T, Warner Bros. Discovery. But I will say this, anything in purple is the allocation by market value of my portfolio. So again, I'm not perfect, and you'll take Microsoft, it makes up over 21% of my portfolio. So I definitely am overweighted there and need to bring that down. And there's some other stocks that I need to bring down as well, and others that I need to bring up. So I still am diversified, though. I'm in different sectors and different companies within those sectors, and I'm in an international ETF. I'm in SCHD, which is a dividend-focused ETF. I have an energy ETF, a materials ETF, and then individual companies I'm very bullish on, except for those that I mentioned I want to sell out of. So if we take this into looking at the allocation by the sector, or shall I say section, because not all of these are sector investments, because I have, like I said, the international ETF, the Schwab dividend ETF. But really, my goal is to make SCHD, which is down there on the right, highlighted in green, 25% of my portfolio. Right now, it's below 10%. So I have a ways to go, which means the rest of my sections, I want an average of about 6 to 7% target. Now, some of them I might be more bullish on, so I might want to up it to a 10, maybe even 12%, and bring others down that I'm not so bullish on, and that's fine. But overall, on an average, 6 to 7%. So technology, or shall I say anything circled in red or highlighted in yellow, I'm overweight on technology, consumer discretionary, industrials, and financials. Though financials I'm very bullish on, so 10% might be my target there, the SPGI, S&P Global stock that I hold. I'm very bullish on that long term. And then I'm underweight in areas like consumer staples at just 0.2%, energy at 0.9%, materials at 1.8%. So I definitely need to balance this better. But I will say this is not taking into consideration one thing. And it's the money I have on the side in a money market fund, which if I put that in here, it would definitely smooth things out better. And the money market fund right now is paying really good interest. It's paying a really good yield, shall I say, about 4.5% because of the Fed upping rates, 10 times already in a row. And so this is a good place. I'm parking my money for now until I have that opportunity. But when I do deploy that money, it's a decent amount, it will smooth this portfolio out. And again, it's a younger portfolio. It's not very mature. So I think it's okay to be a little off on your targets. Now, that's diversification. Very important, and that will help keep your portfolio safe, lower the risk, and promote future growth. The other 2 things are strategy and quality. Now, I have a quality checklist. This is my strategy on picking quality stocks, and I really recommend everybody come up with something like this. Now, on this quality checklist, how I pick individual stocks is they have to hit at least 5 of these 6 points. If they hit all 6, I buy. If they hit 5, then I need to be bullish on it for some reason that I'm okay just having it hit 5 of these. But that includes, on this checklist, it must have solid financials, a good management team, have good brand recognition, have good products and services, like, have a good ecosystem or create that customer dependency. It has to have a big moat and be at a good valuation. If it hits all 6, it's a stock that I will buy. But if it doesn't, then, if it hits that 5 or below, 5, I could buy, like I said, if I'm very bullish for some reason, but really I won't buy it if not. And that's my strategy, and I stick to that, which I believe has created a very solid, profitable portfolio, and long term it's going to be very good for me. So by sticking with this, that leads me into being patient. I can't tell you how many times I was not patient and ended up biting me in the butt. And I say this a lot, but part of patience is do not emotional invest. We get thrown at us daily headlines and news and scary stuff and buy, sell, sell, sell. And with our phones at our whim, we can buy and sell just like that. So being patient is key. Sticking to your strategy is part of being patient. And making sure you're diversified, all that stuff falls into patience, I feel, because there's times where I sold out of a stock too early because I got impatient, or I didn't wait long enough like I told myself I should, and I ended up buying at a lot higher of a valuation. If I would have just stuck to what I initially came up with and analyzed, it would have been good. So I've had some losses because I wasn't patient, so that's, I think, very important. So please focus on diversification, quality, strategy, and patience, because many people try to beat the market by cutting corners, and usually the market ends up beating them, just like the gentleman that I shared his post. And again, it's not about a competition and trying to beat something. It's more about creating a solid, diversified, quality portfolio in companies that you have a high conviction will be profitable long term, and that's going to make you money. That's going to make you wealthy and rich. So that's what you need to focus on, because I'm not a day trader. I don't focus on the short term investing. That's not me. That's not how I think is the way to become wealthy. Very few people are successful at that. So there you have it. Diversification, quality, creating a good strategy, sticking to it, and being patient is how you create a very strong portfolio, lowering that risk and avoiding a situation like the one we shared today, that example. So let me know if you've learned any hard lessons and how you plan or did avoid those issues going forward. How did you set up a strong, strategy to not fall into that massive hard lesson a second time? And if you have any advice for us, please type it down in the comments and please share it, because we're all in this together, and on this channel we are an investing family, and we're here to help each other become wealthy long term. So thank you guys so much for listening on this short, important video, and I hope you guys have a great day. We'll see you next time on Mark Arnold's Finance.